The global meat market in 2018 was worth just over $945 billion and estimated to reach $1,142 billion in 2023. That's a 20% market size increase in 5 years. Also, 8% of the world's population has been identified as vegan, vegetarian, or something in between. There is a massive market out there for plant-based meat producer Beyond Meat. It's also the biggest player in the alternative meat market, and they boast their production processes require 99% less water, 93% less land, 46% less energy, and they produce 90% less greenhouse gas emissions. On top of that, with a green revolution happening, legislation might squeeze traditional meat producers and drive up their prices, while Beyond Meat will have the eco advantage and ultimately the cost advantage. So, why is the stock price dropping? Welcome to Stocks Daily, the channel where we invest smart and let the billionaires do the work for us. So in today's episode, we're going to first discuss the good, the bad and the ugly of Beyond Meat. Then we're going to have a look at financials. Then we're going to have a look at the charts to find out what's going on and if we should invest. There's a lot to get through, so let's get stuck in and start with the good stuff first. Growing global populations obviously mean increased food and meat demand, with land bottlenecking production driving up costs. And of course, this current meat inflation is caused by the pandemic and all of the shortages, but the meat prices globally have been rising steadily anyway. And on top of that, with the greenhouse gas pollution caused by the animals' methane, it's all causing quite a stir, and people are talking about adding a climate tax to meat producers, and a study done by a German university says it could increase meat prices by 146%. Beyond Meat's products avoid all of that. No land bottleneck, 1/10 of the greenhouse gas emissions, less production costs, and it really seems like a long-term solution to an imminent global problem. We definitely need some sort of alternative high-tech food solution, but we just don't have a food replicator yet. And no one wants to eat beetles.
What's this?
What do you mean, what's this? It's puree of beetle.
So we'll have to settle on plant-based meats, or in the future we're going to have to pay top dollar for that real sirloin steak.
We no longer enslave animals for food purposes.
But we have seen humans eat meat.
You've seen something as fresh and tasty as meat, but inorganically materialized out of patterns used by our transporters.
Sickening. It's barbaric.
In addition to the feel good about fixing the world factor, vegan diets of course have gained a lot of traction in the past decade, with people transitioning saying they got more energy, clearer minds. Some people do it for social media, but some people do it for genuine health reasons. A lot of people who've tried Beyond Meat products have given it great reviews, but not everyone. Some people say it just tastes like a veggie patty. Others say blindfolded you can't taste the difference. Either way, if you want meat but you can't have meat, you don't got a choice. So it's basically market disruption for the good of mankind. So why is the stock going down, you're asking? We'll get to that, but there's a few more good points that I want to point out first. Beyond Meat has a partnership with Pizza Hut, who's owned by Yum Brands, who also owns Taco Bell's, KFC and some other chains. So that's a great partnership to have. They also have a plethora of partnerships with retail stores around America, which is fantastic. But they were getting into business with McDonald's, but of course McDonald's snaked them, and now McDonald's are going with their own McPlant burgers. More on that later. Beyond Meat's also expanding into China with agreements to build 2 more production plants around Shanghai, which will significantly increase their exposure and give them access to 50 to 70 million vegetarians, with there being only 12 to 20 million in the US in contrast. Also, what I like about the company is their brand presence, their marketing, their innovation, and especially their founder, CEO Ethan Brown, who's passionate about the industry. He's got experience in the industry, and he's somewhat of a visionary. He's basically like a low-level Elon Musk. The company also had massive growth in the past few years, with analysts predicting 50% or more growth year on year. But before you go and invest all your money into the company right now, let's see why we need to be cautious. Beyond Meat basically repurposed their stock and rerouted a certain portion of their existing food service inventory into retail. I mean, that doesn't sound too bad, because the benefit is that the inventory doesn't get wasted. However, The real problem is that the margins get compressed because the retail sales yield lower profit margins than the food service, which led to increased net revenues in the retail channels, but it negatively impacted gross margins. Beyond Meat's management is unclear how long it will take for food service demand to return to pre-pandemic levels, if at all. On top of a business segment on life support, Beyond Meat has a lot of competition on the rise, so I'm somewhat worried about their moat. But hopefully, innovation, marketing, and their technology can keep them as the market leader. That's all in the hands of the management team. Look at Tesla. They've been saying the competition is coming for 10 years, and Tesla's always 3 or 4 steps ahead of the game. Maybe Beyond Meat will also keep its first mover advantage. But in addition to food service revenue dying and rising competition pressuring future growth, a new round of lockdowns present continued risk to the growth with no end to the pandemic in sight. Also, McDonald's deal fell through because greedy Ronald McDonald didn't want to share and wanted all the profits for himself. And more on that later when we look at the graph. Personally, I don't think the food service demand will return in 2021, especially because these healthy vegan type of restaurants were already on tight margins and a lot of them are shut down with big dogs like McDonald's taking over. I do, however, see the plant-based meat demand going up over the next decade or 2 decades, especially as populations grow. I really think the big winner for Beyond Meat is expanding into China, expanding into India. There are millions of people that are vegetarian and vegan in Asia, and especially in India. Way more than the States, and the products Beyond Meat can offer them will have insane demand if this priced correctly. I also think that the whole Roni situation will make people warier of meat products and live animal products, and those people will probably at least want to try plant-based meat alternatives. And if the products taste good and the price is right, then that's a customer for life. So let's look at the financials and see where we've actually gone wrong. So if we look at Beyond Meat's hyperchart, straight away from the revenue segment, we can notice that in 2019, food service revenue was somewhat dominating retail with about 60% of revenue coming from food services. And as we discussed, food service revenue had better gross margins. In 2020, we get all of the shutdowns and food service revenue drops off a cliff. Inventory got repurposed for retail, hence why retail is up so much in Q2 and Q3, and we can see how the revenue segments affected profits. As we discussed earlier, the retail revenue has lower margins, hence why revenue is up in Q2, but operating income is down. And in Q3, it performed even worse because you got the retail shops going back to somewhat normality without people panic buying. Food service and restaurants are still dead. Net income reflects the same thing. Poor margins led to abysmal net income, irregardless of revenue being up year over year. And operating expenses are playing a role. Expenses up, revenue down, margins down, and that of course results in bad quarterly results, excuse the pun. R&D up, which I love to see. I love a company that innovates. For me, if a company stops innovating, it's time to pull out. Also, they got a fair bit of cash left on the balance sheet, but they did take a 10 million hit in Q2 and a 19 million hit in Q3. But with 214 million left on the balance sheet, they could survive for another few years. They had to borrow some money in Q2, but their overall debt looks low. So obviously they're not going anywhere. And post-pandemic, the world will be their plant-based oyster. I should pitch that to Ethan. Anyhow, so let's have a look at the graphs to see where we can buy in. The Beyond Meat stock price is intrinsically related to the company's ability to generate a profit. In Q1 2019, the company beat estimates and hit all-time highs. Q2, it missed estimates, and the net income, which was improving quarter over quarter, fell for the first time in 3 quarters. In Q3, it beat estimates and had its first profitable quarter, but analysts downgraded the stock because they said it was overvalued and in a bubble. And a lot of the founders and employees sold their stock because the lockup period was over, and that diluted everybody's shares. Around the $80 region, it found a lot of support, and in 2018, it started gaining a lot of hype due to the company's growth. And of course, the Roni hit in March, and it dropped to an almost 1-year low. It started looking really attractive around that price, and it had a nice run up, almost tripled in price and had a correction, held strong around the 125 region. Then the partnership news started coming out with Yum Foods and McDonald's, which gave it a lot of hype, and it became really overbought. So it had this massive correction over here. And then the McPlant burger made the price gap down 35% in one day. So we can see here, it went down about 35%, 34% gap down in one day. But we see a lot of support around the 125 region. So I would say that is a decent entry point. If he was trying to get in now, I would say around this sort of region is a decent entry point. However, I would start loading up heavy in this sort of region here. So between 125 and 106, I think that's a decent sort of entry point. It would be a good area to start buying. But if the lockdown is extended through 2021 and the food service segment of the business doesn't recover and the margins stay low, I can see the stock price hitting maybe $90. So I can see it hitting here. And if it hits $90, I think there's going to be a lot of buying. A lot of people are going to find that an attractive price. Myself, I'm going to probably buy heavily if it hits around the 90 region. I don't see it going down below that because the company is obviously growing very fast and they do have China coming up. Q4 2020 forecasts are currently around a loss of 0.117 EPS. If they manage that, then it wouldn't be as bad as Q3, which was basically a loss of 0.3. But I really believe that when the China factories start opening and scaling up, that will dramatically increase revenue. And if the margins are good, I can easily see this hitting all-time highs by 2022. So potentially maybe 240 by the end of 2021. So to sum up, the company has great potential for the future in a rapidly growing market with the wind at their back for the long term. But short term, they're plagued with shutdowns and damage to the food service restaurant side of the business, and they got a dodgy moat. But the company does have a good management team that's founder-led. It has originality with a lot of innovation, a lot of innovative products, great marketing, great production technology, and the fundamentals were looking fantastic pre-pandemic with great growth, albeit they did have a bad 2020, but so did every other company in the world, bar a few tech stocks and crypto. Obviously, they're not going anywhere, and with expansion into China, I'm very bullish on the long term. So leave in the comments below if you have conviction in this company, and like always, smash the like button and subscribe if you want to see more content like this. If you're still watching, then you're awesome.